Welcome to our mid-year economic and market update, which we've entitled Shifting Sands. Now, while we believe that the economic expansion has got further to run, we do believe that peak growth is behind us from both an economic and market expansion perspective. Things will remain decent, but we're unlikely to see a further acceleration from current levels. Now, from a market perspective, that to us suggests that between now and the year end, we'll have equities outperforming the credit markets and the bond markets. Now, our publication that we've entitled Shifting Sands, that relates to some fundamental shifts that we see happening beneath the surface. One of the main ones, of course, is on the political front, where we see the populist political movement continuing to do well and perhaps even do better. We're seeing trade tensions continuing to build and escalate. And of course, we've had oil prices that have moved significantly higher over the course of the last 12 months. But also, we've seen financial tightening. Now, Charlotte, what does this financial tightening mean for Zurich? Because, of course, it can take many guises and is multifaceted.
So since the beginning of the year, 1/3 of major global central banks have raised rates. And the one that's leading the way is the Fed. And the Fed has become a bit more hawkish over the past year, partly because the US economy is doing very well, the data is very strong. And this has also led to a sharp strengthening in the dollar. It's up roughly 6%. Over the past 3 months, and this of course is putting pressure on emerging markets. So in Asia, but also in LATAM, we've seen many central banks now being forced into a rate tightening cycle a bit earlier than was expected by the beginning of the year. And of course, for more vulnerable economies, there has been some adjustment which has been disruptive for the local economies. So this is in line with our view that peak growth is likely to be behind us. It will weigh on demand going forward. So it matters for Zurich, for the group. Now, we don't think this will be the factor that's going to end the cycle. And there are a number of reasons for that. One is that in developed markets, conditions are still extremely benign, and we don't think growth will suffer near term. Emerging markets more mixed, but if you look at the overall macro fundamentals, they're still in much better shape than they were in previous crises and corrections. China, we got some stimulus, some liquidity injections into the local economy. That should help stabilize growth going forward. And finally, inflation, still low at the global level, so that gives some policy space to central banks if you were to see growth slowing more than expected. So wrapping it all up, it is consistent with peak growth now being likely to be behind us, but still over the near to medium term, resilient growth in the global economy.
Thank you, Charlotte. So a decent but still fragile outlook. Remember that this full publication, like all our publications, is available on zurich.com/MSME. Thank you.